Hello and welcome to our guide on why and how the government raises interest rates to control inflation, and how inflation rate is calculated. In this video, we'll explore the relationship between inflation and interest rates, and how the government uses monetary policy to control inflation. We'll also explain how inflation rate is calculated and what it means for the economy. Let's get started. Understanding inflation. Inflation is the rate at which the general level of prices for goods and services is increasing, and subsequently, the purchasing power of currency is decreasing. Inflation can be caused by a variety of factors, including increases in demand for goods and services, rising production costs, or other economic factors that impact supply and demand. High inflation can have a negative impact on the economy, such as reducing the value of savings and investments, and increasing the cost of living for consumers. The role of interest rates are the cost of borrowing money, set by the Federal Reserve. When the Federal Reserve raises interest rates, the cost of borrowing money goes up, which means businesses and individuals are less likely to take out loans or use credit. This, in turn, slows down economic activity and can help to control inflation. The mechanics of interest rate control. Now, let's talk about how the government uses monetary policy to raise interest rates and control inflation. When inflation starts to rise too quickly, the Federal Reserve may decide to increase interest rates. This can be done through a variety of methods, such as adjusting the discount rate, the rate at which banks can borrow money from the Federal Reserve, or changing the reserve requirement, the amount of money banks are required to hold in reserve. As a result of these actions, banks will raise their interest rates on loans and credit, which will make borrowing money more expensive for businesses and individuals. Calculating inflation rate is calculated by measuring the percentage change in the Consumer Price Index, CPI, over time. The CPI measures the average price of a basket of goods and services that households typically purchase, such as food, housing, transportation, and medical care. By tracking the CPI, economists can determine how much the general level of prices has increased or decreased over a period of time. To calculate the inflation rate, economists divide the difference between the current CPI and the previous CPI by the previous CPI and then multiply by 100. The impact on the economy and consumers while raising interest rates can help to control inflation. It can also have other economic impacts. For example, higher interest rates can make it more expensive for businesses to borrow money to invest in new projects, which can slow down economic growth. Additionally, higher interest rates can make it more difficult for consumers to afford big-ticket items, like cars or homes, which can impact the housing market and other consumer-driven sectors. Conclusion: in summary, the government raises interest rates to control inflation by making it more expensive to borrow money, which slows down economic activity and can help to stabilize prices. Calculating the inflation rate is an important tool for understanding the health of the economy, and can help policymakers make informed decisions about monetary policy. Thanks for watching.